Hey everyone, welcome to Capital Markets Quickie. I'm your host, Endrit Sella, here to catch you up on what happened in the markets yesterday. So, here's the big story. The Dow Jones Industrial Average closed at a record high on Monday, ticking up just over 0.1% to hit 41,240.52. But while the Dow was celebrating, the other major indexes didn't share the joy. The Standard & Poor's 500 slipped by 0.3%, and the Nasdaq Composite fell about 0.8%. Now, what's behind these moves? Well, tech stocks, particularly those tied to AI, took a hit. Shares of Nvidia dropped 2%, dragging down the tech sector along with companies like Broadcom and Tesla. Investors are clearly nervous as we head into a busy week, with Nvidia's earnings report on Wednesday being the main event. This report is going to be crucial. If Nvidia doesn't meet the sky-high expectations, it could put the brakes on the recent AI-driven rally that's been boosting the markets. Last week, we saw all the major indexes gain over 1% after Fed Chair Jerome Powell made it clear that the Fed is ready to start cutting rates in September. Markets are now pricing in a total of 1% in cuts by the end of 2024. But with only 3 Fed meetings left this year and some key economic data still to come, including the August jobs report, there's a lot of speculation about the timing and size of these cuts. Also on the horizon this week is the Fed's preferred inflation gauge, the PCE index, which drops on Friday. And don't forget about Thursday's second quarter GDP reading. Both of these will play into the Fed's rate decisions and could move the markets. In the energy sector, oil prices surged around 3% yesterday. This was largely due to reports of production shutdowns in Libya and rising tensions in the Middle East after Israel and Hezbollah exchanged strikes. Brent crude settled above $81 per barrel, while WTI crude finished above $77 a barrel. Well, that's it for today's Capital Markets Quickie. I'm Endrit Sella, and I'll be back tomorrow with more market updates. Thanks for tuning in.